All right, welcome back to how to learn to trade from scratch. In this video, we're going to be talking about the advanced side of things. So if you haven't watched this to now, go back and watch the last few videos on this, because not only do I give you a great document that you can work through here and you can download that for free, but we've also gone about it in order so that you'll get the most from this if you start at number 1. Now, this is where things start to separate hobby traders from serious traders. So in this episode, we're diving into front running, front running and order fills. We're going to be talking about positive and negative carry. We're going to be talking about advanced money management strategies, multi-time frame analysis, portfolio building, funding your account, and then scaling up. And we're going to be talking about capital partitioning. And I'm also going to include a mindset segment to help you avoid one of the most common self-sabotaging behaviors that I see in traders. So let's get stuck in. All right, so first, let's talk about front running. And I don't mean the kind of illegal kind where brokers front run client orders, okay? I mean smart, strategic approach to ensuring that you get filled, especially around structure-based trades. So as a retail trader, you've got to account for broker spread and slippage. So if you've got a great setup and we've pulled back into support and you see a deceleration candle or a known price level waiting for that textbook break of structure, or the candle closes perfectly, it might mean that you miss the entire move just because you haven't front run your orders. So front running in this context, what I'm talking about here, it means that you just enter slightly before your ideal level or confirmation area. And all that does is it just ensures you get filled and you stay within the risk parameters of your trade. So it doesn't mean jumping into a trade early without reason. It means building clear rules around anticipated price zones and then accounting for real world mechanics of execution. Because if your edge is valid and your risk is managed, right, getting filled matters more than being perfectly right. Does that make sense? So I'm sure there's times where you guys have seen price come down and you've placed your order and you don't quite get filled, and then market just carries on in the direction and you was right. Your prediction was right, but you didn't. It took off without you. You didn't get filled. Well, if you'd front run your orders, it would just give you that extra confirmation or confidence that you're going to get filled in that move. So front running orders is placing your order just above or below the setup zone or the entry zone, and the same with your targets and stops. So instead of, if your target is at 1.025, right, you want to just place your target at 1.0248. Okay, and just by having a couple of pips below that level is more likely that you're going to get filled. And the opposite with your stop loss, you give it you basically give it some more breathing room. So if you're front running your stop loss, basically it's the opposite. So if my stop loss is at 1.250, I just want to put my stop loss just below it. So if market dips down, I've got an extra 2 pips there as a buffer. All right, let's now look at positive and negative carry. This is something that a lot of people don't talk about, and it's especially important for swing traders in the Forex market. So when you hold trades overnight, you're subject to interest rate differentials between the currencies, and that's what we call carry on the trade. Now, I'm sure there's been times where you've gone live with a broker and you've tried to make some money in the markets and you think, how am I not profiting? Well, there's like a silent cancer in your trading account that are these overnight costs that could be crippling your chances of ever becoming profitable, but they're not always bad. And I'll explain in a minute. If you're long a currency pair with a higher interest rate and short one with a lower rate, you'll earn interest. And that's what we call positive carry. So you can actually make money holding trades overnight. But if it's the other way around, you're paying interest, and that's what's called negative carry. And that is what shows up in your broker account as rollover costs, or swap fees, they call it. Now, it might seem small day to day, right? But over the weeks or over the months, it really adds up. And if you're not factoring it into your strategy, it can silently drain your profitability. So the lesson is very simple. Know your pairs, know your holding time, and know your carry cost. All right, money management. This is a big one. And it's not just how much should I risk per trade, but how you grow and allocate your capital over a long period of time. So let's start with the standard approach, and that is fixed fractional. And I want to stop at this point and say, if this is going a bit too far for you, it's because you've just started watching this particular lesson and you haven't watched the previous lessons. And we are going to get a bit, we're going to get a bit deep here. So it's not going to be something you're going to understand on the first run through. You're going to want to save this video. You're going to watch it again, or maybe check out some of the other videos on my channel after this one, which I'll put at the description. So the fixed fractional method means you risk a set percentage of your account on each trade. Okay, so say 1%, for example. So if your account is £10,000, your risk per trade is £100. And then if your account grows to £20,000, your risk is now £200 on each trade. And it scales with your growth, and it's very simple and effective. But one thing the fixed fractional doesn't take into consideration is how many trades you're in at any one time. So if you're in 10 trades at once, and there's a correlation risk, and you're risking 1% per trade and they all go against you, you've suddenly wiped out 10% of your trading account. Okay, so for that reason, I prefer a different method. There's a more refined method that I want you to know about, and it is called smooth ratio money management. And what this model does is it adjusts your risk based not only on your account balance, but on your trading performance over time. Now, this model adjusts your risk based not only on your account balance, but your performance over time, your trading performance over time. So it considers your equity curve, your drawdowns, even your wins and your loss rate, and it adjusts your position size accordingly. It's much more dynamic, which means smoother growth, which I like, and reduced exposure during poor performance phases. Basically, you accelerate when you're doing well and you protect capital when you're doing worse, when you're going through those drawdowns. So for me, it's a much more intelligent risk control. And when you're ready for it, it's very, very powerful. That's the secret to making lots of money in trading. But in both cases, the goal isn't just to make more money, it's to stay alive long enough to make more. As I say, in poker, you lose your chips, you lose your seat at the table. All right, let's talk about multi-timeframe analysis. It's one of the clearest ways to sharpen your edge is to use multi-timeframe analysis. And I've done plenty of videos on my channel that you can go and watch, but here's how the professional traders use it. So they'll use a higher time frame, say the daily or the 4-hour time frame, to establish a bias in the market. They'll then use a mid time frame of the 4-hour or the 1 hour to spot structure. And then they'll use a lower time frame, say the 15-minute, and again, I'm just using these as examples, or the 5-minute to enter for precision entries. And they'll also use them to manage trades as well. And this top-down approach means that you're never trading in the dark. You don't want to be long on a 15-minute chart whilst the 4 hours breaking down. Your setups should align like gears in a machine across all the time frames. And when they do, you'll feel more conviction, you'll have more confidence, more clarity, and fewer should I stay in moments, which I know lots of you have had. All right, let's talk about portfolio building. Every trader needs a portfolio, even if you're only trading a few markets. And here's how you build it. So you start by selecting instruments you have tested and understand well enough to include in the portfolio. Stick to 3 to 6 pairs, particularly if you're new, and pick ones that match your personality. You've heard me talk about this all the time. And when I say personality, your strategy has to match your risk appetite, basically, and your lifestyle. You don't want to be trading setups when you're not available. If one certain pair is prolific at lunchtime, you don't want to be in that if every lunchtime you've got meetings. Just the same as if the strategy you're trading on that pair has a reward to risk profile of 3-1 or a 1-3, and you like being right more than you're wrong, well, you don't want to be trading something where you're wrong more than you're right. Make sense? You also want to be mindful of correlation risk. If you're long the Aussie dollar and long the New Zealand dollar, you're essentially doubling down. So think in terms of exposure buckets. Currencies, indices, commodities. Spread your focus where it counts. And don't add new markets to that pot just to feel busy. That's the worst thing you can do. More isn't better. Better is better. All right, let's talk about account funding and scaling your account. So how do you go from trading a 2K account to a 100K pot? Well, here's how smart traders actually do it. They fund their account from their job or business. And what they do is they keep contributions consistent, and they only scale once consistency in their trading is proven. Okay? Once I decided to become a professional trader, I wanted to make sure first that I could prove to myself that I could be consistently profitable over a period of time. And then only at that point would I take my hard-earned cash from my business or my job and stick it into my trading account. And what I did after that was continuously fund my trading account, because it's basically topping up the capital that you can use to accelerate the capital. And once you're profitable, okay, you have this newfound confidence to chuck any spare cash into this machine that can grow money. Until that point, if you're not profitable, you don't have that confidence. And if you don't believe me, go and ask someone to borrow some money to trade with. They'll say no, unless they can see your results. Another thing you can explore is prop firms. Okay, so real prop firms. Once your backtesting and your live strategy's been proven, okay, you can go to these prop firms and you can say, here's my performance, give me some money. But what I would do is avoid the trap of going all in after one good month. Okay, that's a big mistake. You want to be thinking of your growth and how it should look like a staircase, not a flipping rocket. Slow, consistent, stress-free. That type of scaling beats emotional overexposure every time. And any investors that are going to look to put money in your pot are going to look for that in your equity curve. All right, this is something you don't hear much spoken about, and that is capital partitioning. So this is how you protect yourself from blowing up everything at once. And the way you do it is you'll break your capital into distinct buckets. So your live trading account, which is your core strategies. Then maybe you have an experimental account for trading new strategies that you're bringing online. Maybe you have a cash in some kind of buffer fund, right? Or stable assets. And maybe you've got some cash in long-term investments. So the first part of this is talking about really portfolio allocations. It's wise to have the majority in your money in kind of steady and slow growth assets. And then as you earn your right to higher degrees of risk up to trading, you put a smaller portion in that account and you trade with it, and the whole thing grows, okay, at a steady, stable and scalable rate. But the capital partitioning that is rarely mentioned is the way that you can protect yourself from brokers and banks, right? So think of it as not putting all of your money into one place for working in the market, okay? So in your trading account, for example, you might have, let's just say you've got a 100K account, okay? Well, instead of trading that 100K in a broker account, you take 50, for example, put 50 safe into other assets, like I just explained, and you trade the remaining 50 as if it was 100. So if your risk is 1% per trade, for instance, your trade with 100K would be £1,000 per trade or $1,000 per trade. Well, you take 50K and put it safe, you still trade 1,000 per trade on the 50K. Make sense? So you're treating it as if there's 100K there, but you've actually moved 50K elsewhere. This can also help you stop making decisions from a place of fear, because you know that your entire pot isn't in there. Why might you do this? Well, there's been plenty of times in history where brokers have just gone bust and they've taken client funds down with them. Same with banks. Banks shut their doors. They can't pay you out, right? So it's just a way of putting your money in different pots to keep it safe. All right, so look, I just want to stop for a sec and say you're watching this series. One of the things that I must stress that I don't want you to be is an arsehole. Don't be an arsehole. An arsehole is someone who asks for help, gets advice, great advice, and then completely ignores it, or they do the opposite to what you've told them. And I've seen it too many times. They get mentorship, they get strategies, they get feedback, and then they go right back to the same bad habits, or they look for something else. Don't ask for a roadmap if you're not going to follow the directions. Take ownership, apply what works, get belief from someone further down the road to you until your results speak for themselves. Okay, and then finally, let's just talk about the mental side, okay? Your brain has filters. Deletion, you ignore things that you don't value or believe. Distortion, which means you twist reality to justify your actions. And generalization, which is, I always lose, even if it's just 3 trades. And the antidote for that is repetition, repetition, repetition. Repetition creates clarity. Clarity builds belief. Belief fuels your execution. So do the work again and again and again until you're who you want to be. So this is the advanced stuff, okay? This is where traders stop acting like hobbyists. They start performing like professionals. They understand you don't need 100 strategies. You need structure, belief, and discipline. And this is the stuff that I've gone over that you just don't see taught online. And if you want to learn more about this stuff, definitely check out some of the resources and some of the other videos that I'll link in the description that will help you deep dive on this even more. And if this video has helped you, and if this video has helped you or opened your eyes in any way, please give it a like and subscribe to the channel if you're not already. And let me know in the comments what your biggest insight has been so far in this entire series. Oh, and if you want the workbook for this document that we're building out, you can grab that in the description as well. Thanks for watching, and I'll see you in the next one.